All right, yes guys, welcome back to another YouTube video. All right, in today's video, we're gonna be breaking down ICT breaker blocks, and we're gonna be literally explaining everything that you need to know from A to Z about breaker blocks and how you can use them towards your advantage and maybe even add them into your own trading strategy or model. So as you can see by the background, we are in Miami Brickell. Okay, I'm currently in a hotel because I'm still waiting to move into my apartment. First things first, let's start off with the definition of a breaker block. Okay, what even is a breaker block in the first place? So a breaker block is created when price displaces in the opposing direction, breaking through an old order block and creating a new breaker block. So I'm going to give you a brief explanation here, and this is actually a bullish example. So you have two lows near a sell side liquidity level. The second low breaks below the previous low, taking out the sell stops. Then we want to see price displace higher, breaking above that short-term high, leaving us with a bullish breaker block. Okay, and then the highest up close candle inside of that price leg is going to be your breaker block. So just to explain things a little bit better, and so you can actually visualize this for yourself, I've created a little diagram or example for you lot. So as you can see, we are approaching a sell side liquidity level. Okay, number one, what do? We form that low. Okay, so the first low gets formed near the sell side level. Number two, you'll be followed by a swing high. So number one, swing low. Number two, swing high. Number three, you're followed by that second low, taking out the previous low, which is the sell stops, and creating a lower low, which is then followed by a higher high, which is the last stage of that breaker block, breaking above this short-term high, which was created inside of this price leg. And then the highest up close candle inside of this price leg, which is this one, is going to be your bullish breaker block. So you just mark it out to the side and you wait for price to retrace to that area, which then you can look for some buy positions. And also note how we can actually see a fair value gap in this area. So I teach this on my YouTube channel a lot. It's called the unicorn model. So the bullish breaker block will be overlapping or paired with a fair value gap like this one, and we will call this a unicorn model, right? And it makes it so much higher probability than if you were just to enter off the breaker block. Don't get me wrong, entering off the breaker block is still high probability, and I sometimes do it when there's no fair value gap formed. But of course, if there are more P/E arrays in one area, the high probability that trade is going to be. So if you have an order block, a breaker block, a fair value gap, if you have a ton of P/E arrays and a ton of confluences in one area, it's going to be 10 times more high probability than just entering off one confluence. Okay, so let's say for example we even have an SMT at the lows, right? That's going to be an extra confluence and signal to me that price wants to reverse here and head higher. So hopefully that makes sense. Now let's move over to the bearish example. Okay, so here we go. Number one, we form that high. Okay, so we're coming up towards a buy side liquidity level. We form a high, which is then followed by a swing low, which is then followed by a higher high, taking out that previous swing high with all the buy stops, and then lastly followed by a lower low, breaking below this swing low, which was formed inside of this price leg. And in this case, because it's a bearish example, we're going to be picking the lowest down close candle inside that price leg as our breaker block. So this candle right here is going to be our bearish breaker block. So it's literally the same thing, okay, just a bearish example. So instead of two lows near a sell side liquidity level, it's going to be two highs next to a buy side liquidity level. And remember, the second high has to take out that previous high where all the buy stops are resting. Okay, so what this does, if any traders are trying to short resistance, okay, we get support and resistance traders which try to short at these areas of interest. So they see the buy side liquidity level as a resistance level, and instead of waiting for a displacement, they go short straight away as soon as we get a tap of that level. So what this is going to do is whenever traders are going short here, price will then go back up just one more time, taking out those traders, taking out the buy stops, stopping them out before the real move actually occurs. So yeah, very simple concept. Of course, there's a lot more that goes into it. It's not just a pattern. You actually need some context behind the trade for it to play out. So a good example here is draw on liquidity. Okay, if you know the draw on liquidity is lower and there are relative equal lows resting below, we're coming out of a daily bearish fair value gap, and everything is looking very bearish to you, then if you see a pattern like this on your chart, of course, I don't like to call it patterns because we're not pattern traders. You can decide to take a short entry. Okay, but at the end of the day, guys, this is just an entry model. There's a lot more that goes into it, like psychology and risk management, but this is just one of many, many, many entry models that ICT teaches. But anyways, now that we've gone over what a breaker block is, and I've shown you a few examples of how this entry model actually looks like, we're gonna be jumping into the charts and showing you some live trading examples so you guys can get a even better understanding. All right, guys, so let's start off with a bullish breaker block example. Okay, so this is a very clear example on my chart right here. And as you can see, we've come towards a sell side liquidity level. What do? We come down, we form that first low. What are we looking for next? We're looking for a swing high to be formed next. Well, you can see right here, we have that swing high here. I'm gonna mark that out as H. So far we have a low followed by a high. Now the next step is a lower low. As you can see here, we've come down, we've swept this previous low, taking out sell stop. So any traders going long off support here are getting destroyed and stopped out. So that's a lower low there. And lastly, we want to wait for a higher high, which as you can clearly see here, we have a higher high formed, breaking above this short-term high here inside of that price leg, displacing through and clearly leaving us with a bullish breaker block. Now in this scenario here, the breaker block is actually paired with a fair value gap, which is even more high probability. Okay, this is actually a unicorn model. So I'm going to be marking out this up close candle here. This is the highest up close candle that's left behind inside of this price leg. All right, so I'm going to be placing my buy order just on the wicks high of that candle or breaker block. Stop loss just below a swing low. Then you want to target the opposing liquidity. So of course, in some cases, there's more that goes into it. Now, this stop loss is quite a large stop loss. It's over 50 handles. Now, usually I recommend only risking around 25 to 30 handles max on a trade. However, if you have a trade like this one, where you're risking a little bit more, you can actually half your position size. So instead of going full position size, you'll half your position size. And that way, if you do take a loss on this trade, it will be the same amount that you would lose on a 25 handle full position size loss, but you're risking half position size on a 50 handle stop. So it's really the same thing, but you're just risking less on this trade as this stop loss is quite large, okay? So anyway, stop loss below a swing low, which is a valid area that if price were to break below, this trade would no longer be valid. Take profit is going to be at the opposing liquidity level, which is buy side liquidity. So let's see how this trade would play out. Okay, so there you have it. TP smashed. We came very close to getting stopped out. However, we didn't get stopped out there and we ended up smashing TP. So just to add more confidences now, every time you enter a trade, okay, you want to ask yourself, what can make this trade even higher probability? Okay, you want to add confidences to your trade that will make them play out a lot better. So in this scenario here, as you can see, we're inside of that 9:45 to 10:15 a.m. macro. Okay, so we're inside of that window, which if a trade is inside of this window, it's more likely to play out. Okay, because what I'm expecting inside of these 30-minute intervals is a run on liquidity. Okay, so price usually moves inside of these windows and we tend to have large volatility inside of the markets when these 30-minute time intervals come along. So that's number one, okay? We're inside of that macro, so that's another confidence that's gonna add to our trade. Another confidence that you can add is an SMT. So actually looking back at this trade, ES at the time ended up taking this low here. So NQ has not taken this low, hence this is an SMT, okay? Bullish SMT, if you don't already know what it is, it's when ES would take a low like this one and NQ does not take that low. This signals that price wants to head higher and smart money is in play and hence we move higher. So there you go, guys. There's two confidences already. So you have a fair value gap, you have a breaker block, you have an SMT, and you're inside a macro. That's 4 confidences. What can make this trade even higher probability is if we tap into some higher time frame PDRA. So let's just say for this example, okay, so for the purpose of this video, the higher time frame PDRA just below this sell side level here. We sweep sell side, we tap into a higher time frame PDRA, which is even higher probability. We have an SMT at the lows. We have 2 entry models, fair value gap, which is paired with a break block, that's a unicorn model, and we have a clear drawn liquidity, buy side liquidity. Okay, if we have relative equal highs at the top, that would be even more high probability and a lot cleaner. And there you have it, guys. That would be 5 confidences to a trade setup, which will make your trades play out a lot more and have a more likely chance of actually hitting take profit. Whereas if you just enter straight off a breaker block, okay, cool, you've learned the entry model, you've watched my video, right? And you know how to use this strategy. It's not gonna work as well if you don't pair it with all of these confidences, okay? Because you can have every single entry model in the world, but if you don't pair them together, it's not gonna be as high probability as it would if all of those confidences are in one. So anyways, guys, hopefully that made sense. That's a bullish example. I'm gonna find a bearish example for you lot, and then we'll wrap up the video here, okay? So let's get straight into it. All right, guys, so here you have a bearish example. So let's start off with the basics. What are we looking for? Number 1, okay? We're looking for that first original high. So our first high is gonna be this one, okay? Then we're looking for that low, which is gonna be this one, okay? Then we're looking for a higher high, which is going to be this one up here. And then lastly, we're looking for that lower low displacing below a short-term low that was created within that price leg. So it's going to clearly be this low here. So have a look at this chart and pause the video, see if you can find the bearish breaker block. Okay, so the bearish breaker block is going to be these candles here. You might sound a little bit confused when you hear that. Why is it 2 candles? Why is it not 1? The reason why it's 2 candles in this scenario is because these 2 candles, first of all, the down close candles. So in a bearish example, it's always going to be down close candles. In a bullish example, it's always going to be up close candles. Okay, these down close candles are the lowest inside of this price leg. Now, because they are consecutive down close candles, I like to mark out both of them. Whereas if this candle was green and we just had one down close candle, this would be our breaker block. Okay, so you can still mark that out to be more specific and have a more specific area or zone that you can look for potential short opportunities. However, as it's 2 consecutive down close candles, I'm going to be marking out both of them, and I'm going to be treating that as my breaker block. Okay, so what I usually recommend is I want to see a strong closure below that breaker block in order for me to take a short opportunity. In this scenario though, it's very clean. So what you can do is you can even enter off of this fair value gap. Okay, again, this is another unicorn model. It's paired with a fair value gap, so that's totally up to you where you decide to take your entry. However, just because we are explaining break blocks inside of this video, I'm going to be taking my short entry off a breaker block. So let's wait for a strong closure. Okay, there you go. We had that first significant strong closure here. Now I'm going to be waiting for a retest off that break block in order to take an entry. Okay, there you have it. We've retested that area. So I'm going to be taking a short position off the breaker block here. My stop loss is going to be going just above that swing high. Okay, so this is actually a very good risk to reward. My TP is going to be all the way at the sell side level. So this is a 1 to 3 risk to reward. If you decided to take a short entry off of this fair value gap here, which you can, of course your stop placement will be going above that swing high, and then you'll be targeting the opposing liquidity. So it's very similar. However, you're risking a lot more handles if you take that fair value gap entry model, okay? But usually when you're taking a breaker block entry, you're not gonna have this consolidation or chop around this area. Usually we have just a very, very strong closure. And as soon as we go to retest that area, you'll be taking a short entry straight away, okay? But in this example here, we were consolidating for a long time, and then eventually we have that strong closure here, which then we retested and we entered off that breaker block there. So anyways, let's see how this trade here would play out. All right, there you have it, guys. TP would have been smashed there. Very, very clean trade. So yeah, guys, that is pretty much it for the video. I'm going to leave it there. And again, guys, you can play around with this. Try add more confidences to your trade. So look for high time frame PD arrays above a buy sell liquidity level. So when price goes up and sweeps this level, have a look at the higher time frame chart. Okay, are we tapping into a higher time frame breaker block? Are we tapping into a higher time frame order block or fair value gap? Any sort of these PD arrays, have a look out for. Are we inside of a macro? A macro is the last 15 minutes of an hour, so 8:45, and the first 15 minutes of the next hour. So in this case, we are inside the macro. We're inside of an 8:45 to 9:15 a.m. macro. There are a ton of macros, guys, that you can trade. I personally don't trade this macro, but I know some people do, and they're very profitable. Have a look out for that. Also have a look out for SMTs. Do we have signs that smart money is in play and we're gonna head lower? So yeah, guys, I'm gonna leave you with this, okay? I can make so many of these videos trying to help you guys out, explaining different entry models, etc. But without proper help, you're always gonna be stuck with questions that you wanna ask me about this specific entry model. Should I pick this candle or should I pick that one, etc, etc. There's so many questions that you guys wanna ask me in order to get a deep understanding of this strategy. So this is why we have the live trading signals room, where I literally go live every single morning at 9:30 a.m. New York time. And inside of these live streams, you can ask me these sort of questions, okay, which are trading related, of course. And you can expect a professional answer and feedback to that question, which is then not going to leave you confused, okay? You're actually going to get an answer and you're going to have a deep understanding of that specific topic. So if you guys are still struggling with ICT concepts, okay, let's say you're a break-even trader, or you understand the concepts but you are somehow still losing, or you're just struggling to see profitability, I highly, highly recommend that you let me help you, okay? This is literally what I do with all my students on live stream every single morning. And guess how much I'm charging, guys? Only $100 a month, okay? 95% of these traders out there that provide this type of service that I do are charging 3K plus. Whereas me, I'm only charging $100, and I actually want to see you guys succeed and help you lot, because I know what it feels like to be unprofitable and be struggling with these concepts day in and day out, okay? I've been through all of the ups and downs you can think of, and I've managed to come out on the other side. So yeah, guys, if you are seriously interested, go make sure to check out all the links in the description and go secure your seat today. But other than that, I hope you guys got some value out of this video. If you have, please leave a like, leave a comment, share and subscribe, and I'll see you lot inside the next one. Take it easy.